welcome to the 17th Consultative Forum on Inclusive Insurance. This forum is jointly organized by the Access to Insurance Initiative, the International Association of Insurance Supervisors, the Microinsurance Network, and the InsuResilience Global Partnership, and is hosted here in Bangladesh by Munich Re Foundation and the Bangladesh Insurance Association here alongside the 15th International Conference on Inclusive Insurance. My name is Janina Voss. I work for the Access to Insurance Initiative, and I have the great pleasure of guiding you through the event today. The topic of the Consultative Forum is Climate and Disaster Risk, How to Build Resilience, Bridging the Protection Gap in Asia. And this forum is actually the third in a series of 3 events that we organized on this topic in 2019. The first forum was held in Panama in May, and then we had a second one that took place in South Africa in June. So today's agenda is also enriched by the discussions that we had at these events earlier in the year. So it's great to see you all here today for this third and last Consultative Forum in 2019. To give you a quick overview of the agenda, you can see that we are running a bit late, but I hope that we'll be able to catch up later. So we will start after our welcome remarks with an introductory presentation to set the scene for today. And then the first panel will focus on the role of the industry in closing the protection gap before we turn to supervisors and policymakers after the coffee break and look at how they have gone about promoting climate risk insurance in their markets. In the afternoon, after lunch, you will have the opportunity to change perspectives in our workshop and explore the challenges around introducing insurance products related to climate risk in an interactive session and look at it from a different angle. And this consultative forum in general is very much designed as a platform to foster dialogue between all stakeholders and to be an interactive session. So I would like to ask you to please be interactive, engage in discussions, and share your experiences. Now, I would also like to briefly introduce the organizing team that we are having here in Dhaka. Noelia Garcia and Hugo Fulco are here from the Microinsurance Network. Hugo is sitting here in the front, and Noelia, I think, is at the registration. And they are happy to help you with any questions that you have on the ground. And also my colleague Teresa Pilanda from the HRI team is here and will be happy to help. You've also probably noticed that we have cameras around the room. And in terms of data protection reasons, I would like to make you aware that this event is being filmed. And we will upload the video of the session on our website. So if for some reason you don't feel comfortable featuring in those videos, I unfortunately have to ask you to leave the event, which I hope is not the case. And I don't see anyone getting up, which is great. Great, so with that, I would like to hand over to Professor Rubina Hamidi. She's the Vice President of the Bangladesh Insurance Association, and I would like to give the floor to her for her welcome remarks.
Thank you very much for inviting me to be present here. This session is focused on the insurance and the climate risk changes, climate change risks associated with it. So there are the organizers of this session, if I may recall, A2Z and Microinsurance Network and 2 other organizations are involved here. It is a great thing to discuss that the global warming and the climate change is one of the burning issues all over the world. And here in Bangladesh, it is being affected seriously, especially the vulnerable group. And through these discussions today here, we can come up with solutions for the stakeholders so that they can bridge the gap between the poors and the problems they are facing and how to resolve the issues, how to make the vulnerable people more resilient and to make them strong and able to work for the society. So I think we will have some idea and some recommendations will come up from this session for the stakeholders of Bangladesh so that they can introduce new ideas to the insurance companies so that they can protect the vulnerable people. I wish all the success to the participants and to this session so that they can come up with new things for this field, which is a very important sector for the globally for all the members of the society. Thank you so much.
Good morning, everybody. Distinguished guests, it's an absolute pleasure to be here today in Dhaka and to welcome you to the 17th Consultative Forum. The Access to Insurance Initiative is very happy to be organising this event together with our partners, the International Association of Insurance Supervisors, the Microinsurance Network, and InsuResilience. The IAIS, so the International Association of Insurance Sizes, send their apologies for not being able to join us for today's event, but they unfortunately have their annual conference actually taking place next week in Abu Dhabi, and so it wasn't possible for them to attend. But as the A2I is the IAIS's implementation partner, we'll be sure to share any of the outcomes of today's event with them and with their membership. So the theme of today's event is climate and disaster risk, how to build resilience and reduce the protection gap. The impact of national disasters is huge and on the increase due to climate change. Studies have shown that those who suffer most are the poor and vulnerable. Insurance, as part of an integrated risk management package, can play a vital role in building greater resilience, protecting individuals and communities. However, it is not currently fulfilling this potential. There remains a significant insurance protection gap. Only half of the global losses resulting in catastrophes in 2018 were insured. And then when looking at emerging and developing countries, the situation is worse. There are regions where the gap exceeds 90%. The Asian region is particularly prone to natural disasters. In 2018, Asia was the worst affected continent, actually, in terms of the number of events. And actually nowhere is this truer than Bangladesh, which is one of the most disaster-prone locations in the world, I think largely as a result of its monsoonal climate and coastal morphology. In 2017 study, it was reported that since 1972, the country has experienced a total of 297 natural disasters, flood and storm being the most common. And in terms of human loss, the same study reported that approximately 230,000 people have lost their lives, and many, many more have suffered physical or economic damage. With better advanced risk mitigation and then timely post-disaster recovery, many of these lives and livelihoods could have been saved. And this is where insurance, really comes in. But for insurance to work best, it should be part of a comprehensive risk management strategy. And this requires good coordination and cooperation between stakeholders at all levels. So between government departments and supervisory authorities, between supervisory authorities and the insurance industry, and the insurance industry and consumers. Insurance can provide solutions at a range of different levels. So at the macro level, with the government as a policyholder, protecting its balance sheet against humanitarian relief efforts. At the mezzo level, protecting the economic recovery of institutional policyholders. And at the micro level, protecting micro and small enterprises and poor and vulnerable consumers. These schemes should be complementary, though, reinforcing and strengthening each other against the impact of catastrophic events. However, ensuring this happens in practice is actually not so easy. Good coordination, collaboration, cooperation are essential. Thankfully, countries don't need to deal with these challenges alone. There is a growing wealth of international experience of what has worked well or maybe not so well. And that's why I'm so excited about today's event. In the room here today, we have representatives from the government, from supervisory authorities, from insurance industry, as well as donors and other development partners, working closely with consumers. With that, I end my welcoming remarks, and I look forward to what I am sure will be an interactive and a lively discussion. Thank you.
Ladies and gentlemen, partners, and our honorable guests, on behalf of Microinsurance Network, it's a privilege to welcome you to our 17th Consultative Forum this morning. As you know, we'll be addressing the important and urgent issue of what stakeholders from the insurance sector can do to mitigate the impact of climate risk and natural disasters in Asia. The protection gap for this kind of risk is huge, as Hannah has already explained to us. And the problem, as you all know, is getting worse. Collaboration and coordination between the private sector and the public sector is therefore absolutely critical if we're to ensure that people and their assets not only have the cover they need in the event of damage, but also that we work together to find ways to manage risk better, systematically and in a disciplined way. This requires thinking outside our normal boxes. Climate change and natural disasters affect cities, transport systems, and other infrastructure. They have an impact on health through immediate disasters such as waterborne diseases in the event of flooding, but also through the causes of climate change, notably air pollution, which is shortening life expectancy and adding to the burden of non-communicable diseases that is increasing everywhere in the developing world. As some of you will have seen, the news from Delhi, where the pollution this week has reached a level that is just beyond the charts. They've had to close schools. It's creating a much increased risk of stroke, heart attacks, as well as respiratory diseases. We hope very much that today's forum will result in concrete action, that it will be a move towards increased coordination and awareness, and will support the development of insurance and risk management services that will help vulnerable people in vulnerable countries to better weather the worsening storms. Thank you very much, and I hope that you find the day enjoyable, interesting, and successful.
Thank you very much for inviting me here. Welcome. Dear ladies and gentlemen, the world is changing. In 2017, the Atlantic hurricane season was one of the most devastating and costliest on record, with over 125 billion in losses from Hurricane Harvey alone. In 2018, unprecedented cyclones hit Mozambique. In 2019, Chile's storms flooded Atacama Desert and caused landslides. Hurricane Dorian wreaked havoc in the Bahamas. European heat waves were some of the hottest on record, with 1,500 deaths reported in France alone, and in India, 9 million people in Chennai faced severe water shortages from drought. According to the UN Disaster Risk Reductions Agency and Secretary General Mami Mitsutori, there's even lower impact climate crisis coming up, and now occurring at a rate of approximately 1 per week. Such events get less global attention and media coverage than catastrophes such as the drought in India or the recently recurrent, as I mentioned, cyclones in Mozambique, even though they are equally capable of causing death, displacement, and suffering. And I think it's high time. It's not only 5 before 12, it's past 12 to do something. I would like to give you a framing of today's conference. And I would like to guide you through the question of how the protection gap is widening for climate change. The climate change risk insurance is one of the building blocks to resilience. I want to give you an introduction to that. And I want to show you how global policy frameworks are calling now for action and actors. And you are the actors who can do something here. And you have different roles and key roles for change. I want to elaborate on that. But as Hannah rightly has said, nobody can act alone anymore. We need to work together, so we have a little view into the partnership I'm representing here. Yes, the protection gap is widening, as we heard. And in the last couple of years, we have observed increased frequency and severity of natural hazards, of extreme weather events. Natural disasters in 2017 caused overall economic losses of $340 billion US. It was the second highest figure ever, according to Munich Re publication. Swiss Re also counted in 2018 economic losses from disasters of about 165 billion. And Hannah told us that globally, insurance covered about more than 50%, so 85 billion of those losses only, globally. And by the way, the amount of the 85 billion was the fourth highest one-year aggregate industry payout ever, and above the previous 10-year annual average of 71 billion US. Tragically also is that, for example, last year, more than 13,000 people lost their lives in all catastrophes. So the protection gap is huge because I told that about more than 50% of the losses globally are covered by insurance, but globally, in countries with emerging economies, not even 10% of losses are covered. So the protection gap is huge. It's about really 90% or more. The consequences are huge because if you take the money to recover, you take the money from the budget you need for economic development. And this means that you reduce the global, the GDP. And the GDP, according to studies, could be reduced by 3.3% through the impact of climate change. There are studies, interestingly, that show that countries that have a higher insurance penetration are not losing GDP. On the contrary, if they get reimbursed and recompensated by insurance, it sometimes steers up economy because you have to build up back better and increase economy even. So there's a role of insurance. And I want to give you a flavor of what that means. As Hannah said, let's have an interactive, let's have an interactive conference or today. I wanted to ask you, and leaving the path of my presentation, I wanted to ask who is driving a car. Could you raise your hands? And who has insurance? Okay. And then reflect on how you would drive a car without insurance. Probably that changes a little bit the mindset. Or how would you run a business without insurance? If you consider that if you do set up a business, you also do risk management. You have to think about what would you do if something occurs and you would lose your profit. I mean, you should have to have a business interruption in place. You should plan in advance. And this is nothing, it's not so different. If you look into climate risk insurance, it's one element of a comprehensive risk management, especially now under an increasing threat of climate change. You need a comprehensive climate risk management in place. You need to be aware of the climate risks that can occur, of the climate risks in the region you're living in, and understand better the hazards. Try to map the hazards. Try to model what can happen under certain scenarios if a windstorm with a certain magnitude hits the houses, if floods are occurring. So I think it is high priority to plan ahead, to face the risks, and to think what has to be done. It's also a priority to reduce the risks, not only to prevent and build probably more reinforced houses, or reinforce the structures, reinforce the streets that can be wiped away through the floods. You have to look into very smart adaptation measures now under the threat of climate change. But there are risks you cannot prevent, you cannot reduce or mitigate. And these risks, these residual risks, you have to put into the capital market through risk transfer. So the remaining risks can be managed through these sort of instruments like climate risk finance and climate risk insurance. There are more instruments out. Insurance is just one. And insurance comes in if the loss is very, very high and very intensive and very severe. You cannot pay it from your savings. So you give the risk to somebody who can manage it better. You give the risk to an insurance company. Of course, this also means that you work with the knowledge of the risk. And you can do risk preparedness measures. Early warning systems belong to the risk preparedness. Alerts or response planning. Focus-based financing is another instrument you could use. But also setting up contingency plans in case of business interruption. It's business interruption of your daily business you're doing. You have to cope with the catastrophes. You have to cope with the desperate people that have lost their homes. And post-disaster response and recovery, of course, is also important. This is why when you plan ahead, you know exactly where to put the money when a catastrophe occurs. You know the responsible people, you know the processes, and you can immediately act. So as I said, it's like running a business and planning ahead. And climate risk insurance is one element of it. There are several layers of action, and Hannah explained it. We do have possibilities to work at the governmental level, at a level of communities, and at the individual level. I give you a quick introduction of these different types of action. For example, the macro level solutions are the risk transfer solutions that protect contingent liabilities that the government might face in case of a disaster. or in case of an extreme weather event. There are examples. There are currently 3 regional risk pools out in different regions of the world, in the Caribbean, in the Pacific, and in Africa. The oldest one is the Caribbean Catastrophe Risk Insurance Facility. It's a parametric insurance facility owned and operated and registered in the Caribbean for Caribbean governments. It now also includes some Latin American governments, and it's enhanced. It insures the government risk and is designed to limit the financial impacts of catastrophic hurricanes, but also earthquakes to Caribbean governments. Recently, through the Hurricane Dorian, CRIF, the Caribbean Catastrophe Risk Insurance Facility, made 2 payouts, for example, to the government of the Bahamas, totaling $12.8 million right after the storm has hit. And when I say right after the storm has hit, that can be within 1 or 2 weeks' time, when the need is most urgent. There's another risk pool right around the corner, I would say. It's in the Pacific. The Pacific Catastrophe Risk Assessment and Financing Initiative, PCRAFI, aims to provide the Pacific Islands countries with disaster risk modeling and assessing tools. And there's a newly launched pool, the ZDRIF, which is launched here in Southeast Asia. We can learn from other risk pools. There is one in Mexico, a national one called Fonden, who's got 20 years of record right now and who is quite successful. So we can learn from experiences. Let's look at the next level. Mesoscale solutions. Risk transfer solutions that protect risk aggregators such as banks, MFIs, agribusinesses, export companies, humanitarian organizations, cooperatives. Global Parametics is such a one. It's a parametric and index-based risk transfer startup backed by the UK and the German governments. So it's public-private partnership. It has launched a new climate insurance initiative targeting African and Asian smallholder farmers alongside Vision Fund International and World Vision's microfinance arm. There's the InsuResilience Investment Fund that contributes to the adaptation to climate change by improving access to and the use of insurance in developing countries. And the specific objective of the fund is to reduce the vulnerability of micro, small, and medium-sized enterprises. And there's a lot more out. Looking into the micro scale quickly, these are transfer solutions that protect directly the individuals, smallholder farmers, households, and small and micro entrepreneurs. The remote sensing-based information and insurance for crops in emerging economies called RICE has been helping governments and farmers in Southeast Asia and India to better forecast harvests in the face of an increasing number of extreme weather events. The initiative has been collecting satellite data based in the land under rice cultivation in Cambodia, India, the Philippines, Thailand, and Vietnam. And last but not least, the InsuResilience Solutions Fund also supports development of innovative and sustainable climate risk insurance products. But I want to also have a look with you at the global frameworks that call for action and actors. You know the Sendai framework for disaster risk reduction, which is already more than 15 years old and got a revival after the Hyogo framework, and that shifts states into overall responsibility together with other relevant stakeholders. The SDGs, the Sustainable Development Goals, call for action to all. the governments, the regulators, supervisors, and industry. And the Paris Agreement in 2015, the first time recognized much more adaptation efforts to be needed. And it also included the first time insurance industry, when insurance industry players came on board into the climate negotiations. So different actors have different key roles for change. And you don't have to read all the bullet points here. I just want to show there's a lot that can be done among governments, together with regulators, and together with private sector. But there are all more stakeholders out. But just have a look at governments. Governments can promote risk mitigation, can coordinate better stakeholders, provide public goods. For example, public access to data, very much needed for modeling climate risk. They can help increase financial literacy. Regulators can, for example, provide clear guidelines, inform themselves about innovative insurance products that can be developed or that are out in different regions. And they allow index-based insurance. They can facilitate digital solutions through an enabling environment, but in the end also can educate the customers. And industry, of course, they are instrumental to really implement, to develop the products, to understand what type of products are needed under an increasing climate change threat. And you don't have to be alone, and you don't have to work alone. With the InsuResilience Global Partnership, we are currently gathering over 70 members, countries, private sector organizations, non-governmental organizations, multilateral institutions, initiatives all around the world to develop solutions and to implement these solutions and climate risk finance and insurance in different regions of the world. We have set up ambitious Vision 2025 and published it recently on the UN Climate Action Summit with ambitious goals. I come to that. It's about strengthening the resilience of developing countries and protect the lives and livelihoods of poor and vulnerable people. And also, we are looking into the topic of gender responsiveness. These are two cross-cutting objectives that are developed and are worked into the timely and reliable disaster response through the use of climate and disaster risk finance. And the role of this partnership is to promote and enable the adoption of disaster risk finance and insurance strategies as a part of a comprehensive disaster risk management. We are basing that on 4 work streams that look into standardization, that look into convergence of activities, that really are acting on the ground and implementing solutions. We are building up capacity together with partners, and we try to work together and bring partners together in the end. Our partnership has set up quite ambitious targets, and I brought them with me here. I would just like to put your eye on the 500 million poor and vulnerable people that will be covered against disaster and climate shocks by 2025, where 150 million people are covered by microinsurance. But this is not enough. We don't want to count only protected heads and beneficiaries. We want to look into the more longer-term impact and look and support countries to set up comprehensive disaster risk finance strategies. And last but not least, we are supported by the private sector that puts forward $5 billion US dollars of risk capital and helps to provide the necessary risk capacity and partners up with the public effort here. In a nutshell, and as my last key messages here, it's important to bridge the protection gap through appropriate strategies climate risk insurance is one element of a comprehensive risk management approach, and different stakeholders are needed to realize that. It's an important tool, insurance. It's still underestimated what it can do. And I think we can work and elaborate together and improve solutions here. But it's also important that we work together and reinforce mutually without leaving gaps in the coverage, and work and break down the walls and work together, not work in silos, but really develop together the appropriate approaches we need. I thank you for your attention.
Thank you very much, Astrid, for that very informative presentation and for sharing these interesting thoughts and numbers with us as well. I think that was very impressive. I'd like to see if there are any questions to Astrid at this point from people in the audience. Mathieu?
Quick question on your previous slide and on the capacity provided by the industry. Have you agreed on some mechanism to actually access it, or just like some general commitment from the industry?
Thank you for this question. This is a recent commitment done by the Association, the Insurance Development Forum, together with UNDP and the German government, the Ministry for International Cooperation and Economic Development. And they are currently developing the structures and the framework for this commitment. As I already can say, there's a strong ambition to start with piloting countries really to work through the approach of a comprehensive risk management strategy, starting with feasibility studies, technical assistance, but going on into the area of product development and implementation. So there's a structured approach ahead, but it's currently really framed and developed.
There's another question I've seen, I think.
Hi, thank you very much for your presentation, Astrid. My name is Tara James. I'm from the Munich Climate Insurance Initiative. You showed some targets that we have, that InsuResilience has for 2025. The 500 million covered by predefined financing and insurance, and 150 million by microinsurance. My question is there already an estimate about where we stand currently, and how feasible or achievable are these targets within the next 5 or 6 years?
Yes, I can give you some estimate, but I want to also explain that we are currently setting up more global monitoring and evaluation framework, which is necessary because you need to count numbers on the same basis and to develop the appropriate methodology. We have started out with the original G7 goal with the 400 million, which we now enhanced, and we are supporting 25 according to the last year's numbers, and we are currently running this year's survey. But according to the last year's survey, we are, with the InsuResilience Global Partnership, supporting 25 programs in 78 countries. And half of the programs last year were operational already and covered about, let's say, half of the 400 million, so 209 million people already. The majority of those is covered by the risk pools, of course, but we see that currently microinsurance solutions provided, for example, from the global index insurance facility, the GIF, have developed quite successful business models in several countries, like, for example, Zambia with cotton cooperatives, and they have tremendously increased the coverage right now. So there is some hope. probably not by 2020, but by 2025, all these programs will be operational and will produce beneficiaries. So I think I see the next one, and then the gentleman in the front.
Yes, Thomas Wichers, FSD Africa. The targets you mentioned, and also the partners that I saw on that one slide, there's a lot of commercial. So first of all, a lot of commercial partners are involved. The question is whether the targets are really meant to be achieved on a purely commercial basis, at commercial rates, for example, for the insurance products, or whether the role of governments, the role of donors also includes taking over payments of premiums, or partly at least, or pure public-private partnerships. Maybe you can elaborate on that.
As you rightly have said, it's only possible through public-private partnerships, because our target group are the poor and vulnerable, and to develop solutions for the poor and vulnerable really needs to put all the efforts together, and you need some sort of seed money, some risk capital, for example, put first, and to develop especially products for this particular target group. Yes, and I think just to say this is a kind of approach where all different stakeholders are needed. We are also developing together with non-profit organizations solutions that understand better the needs of the target group. So all working together really is important, not only purely by the private sector. And there was another question. I think we need to, last one, we need to watch the time.
Well, thank you. This is Khalid from Guardian Life Insurance. And my question is to you. In which modality you are just continuing this particular program to support this community with the least economic background? Are you directly contributing the premium, or trying to develop the infrastructure, or try to develop the consent of the large community so that they come under the pool of microinsurance?
I didn't catch all of your question. Can you?
In which modality you are just supporting these microinsurance initiatives? Directly contributing? Are you directly contributing the premium, or trying to develop the infrastructure so that a large pool can come under the umbrella of microinsurance?
Okay, now got it. Thank you. We are directly supporting, but we also support, for example, for the InsuResilience Solutions Fund, the development of products, and the InsuResilience Solutions Fund, for example, sets out a call for tender for prototypes that have been developed through public-private consortia, and supports, let's say, the further development of such prototypes, or the dissemination, puts money where the need is in terms of really develop a market mature solution. So it's really at different levels, and direct and indirect levels.
Thanks again, Astrid. And thanks to everyone for your questions and the discussions that have started right now. But now it's time for our first panel discussion, and we will look first at the role. Okay, let me first go back here. Yes, and we will first look at the role of the insurance industry. The panel will be moderated by Pranav Prashad. Pranav is the thematic lead for agricultural insurance, disaster risk reduction, distribution, and use of technology at the ILO's Social Finance Unit focusing on insurance. He also has over 30 years' experience as a business manager in setting up agricultural and health insurance schemes in India. Pranav, may I ask you to come up and further introduce your panel?
Good morning, everybody. No breakfast? Good morning, everybody. Good morning. That's it. We've all heard that we need to work together. We've all heard the need for partnerships and collaboration. So let's kind of be there for each other and kind of do it together. I will risk repeating a few of the things that Astrid said in my opening remarks, so I will just restrict myself to one statement that a lot of issues that Astrid brought about on the changes that are happening, the impact that is happening, most of these climate-related changes ends up impacting people who are least able to kind of prepare themselves for it, or are least able to have capacities or means and mechanisms and resources to react to them. So I guess what we'll do over the next 1 hour is look at various mechanisms that are being developed for those particular segments and go through that. And to take us through some of the examples that are happening, we have two wonderful speakers with us. And let me quickly get them on the stage here so that they can share the view with you. We have with us Melinda Grace Arya from the Card Pioneer Microinsurance Unit. Melinda, please join us here. Melinda has a number of years of experience handling various accounts, and now as the officer in charge of the Card Pioneer Microinsurance Inc., she is looking at expanding this in Philippines. Card, of course, is one of the largest microinsurance providers in the Philippines, and now with Pioneer, here is an example of the microfinance institution and a commercial insurer working together. So we look forward to hearing what Melinda has to say to us. We also have Matthew Dubell. Matthew, welcome. Matthew is an old hand at this game, having worked both with the microfinance sector and now with the development sector. He was earlier with Planet Guarantee, working on a lot of partnerships in West Africa, and is now with the World Food Program, and he's the insurance advisor here, looking after a large program that we look forward to hearing from, the R4 program, which combines a lot of aspects that Astrid actually mentioned on that entire platform there. And they already have covered over 100,000 people here, so we look forward to hearing their views. So just to get the perspective around what we are talking about is, you heard Astrid doing a little work on it, but with our colleagues in GIZ, we've been working on these aspects for some time. And it kind of brings a nice framework for dealing with how to build resilience. What are we trying to do? We are trying to get people come into a situation that they can cope with the risks that they will be facing, therefore become resilient. And this resilience talks of all the things that Astrid talked of, and insurance being one of the aspects that needs to be looked at, but a very critical one, because as we'll discuss over the next couple of minutes, is that without insurance, the others may or may not be as effective, and how can insurance be a facilitator for making them effective, and the other way around. So with this in perspective, that what is the objective? The objective is to ensure that communities, individuals, people are able to understand what are the risks being faced, and then have enough capacity to deal with them. That is the central core that we are all together trying to work, and we'll focus on some of these aspects and some of the mechanisms that are actually being developed to come to a situation where people are in a situation to face these risks. So with these few words, I'll invite you, Matthew, to take us through what the development sector is doing in these aspects and some of the programs there, and then we'll discuss it as we go along. Yeah.
Well, good morning, everyone. I hope you're awake. Maybe better than me. But I try to make something interesting. Well, first, actually, before starting, I just wanted to say that I really appreciated what Astrid and Pranav just said, like about how insurance and climate risk insurance is actually part of something much broader, which is something I think we've kind of missed the first years of the development of the microinsurance industry. It's good that now things are actually improving and going in a more integrated approach, which is something that is very important for us. So, why insurance for the World Food Program? First, as a humanitarian agency, we have a slightly different perspective, of course, compared to the traditional industry, and I think that's going to be interesting. We do work with the most vulnerable communities to increase climate resilience. Our main objective is to contribute to the SDG 2, which is ending hunger. Climate change has a strong impact on people's life, and in particular the most vulnerable communities. In 2017, the world had 821 million hungry people in the world. And with a 2 degrees temperature increase, potentially 189 million more people would be affected and become hungry. So that's actually like a very, very serious topic, and it's happening now. WFP recognizes the role of insurance as a transfer modality, like food or cash or vouchers, which has become like which are the main types of transfer of WFP, and also as a tool to fight hunger. Again, as a humanitarian agency, our main entry point will be social protection, as we work with households who cannot afford insurance and need regular or very specific transfers in case of shocks. In this perspective, we do work on micro, meso, and macro insurance, but I would mostly focus on micro and macro insurance. But every time we need to develop very specific types of transfer systems. I will focus my presentation on farming activities, livestock, and more broadly climate risk insurance, but of course I won't talk so much about urban areas, which I assume can be something quite interesting for the region. We do work mostly in countries that are very much affected by drought and dry spells, in Africa, in around 10 countries. But we start considering fast onsets outside of Africa and also in some countries like Mozambique to align our approach with our disaster risk financing portfolio, but also to, and also in some specific activities like forecast-based financing, which are not so much developed yet in Africa. So as you can see, insurance as a transfer modality, we see it with 3 key benefits. The direct protection effect through direct coverage, which allows to provide a rapid response through rapid transfers. And that's one of the key value proposition of index insurance, right, is that once there's a shock, it is being measured and we can make the transfer very quickly. It's not happening that easily all the time, but that's actually one of the value proposition of it. Then by promotions, particularly for microinsurance, insurance can be a good incentive for vulnerable households to actually implement measures that reduce their risk exposure or that improve their farming practices and increase their productivity. So overall, insurance can actually stimulate agricultural production. And then the transformative aspect, which means by unlocking access to investment, access to better practices, we contribute to building resilient food systems. Then about microinsurance and macroinsurance. So on the micro side, we have an initiative called R4 that is an integrated climate risk management strategy. It always builds on safety nets or disaster risk reduction measures, but actually, well, the story that we always tell, but that is still very interesting is that the idea comes from a farmer in Ethiopia. I've seen Dan here, so he could actually confirm that. So there is this productive safety net program in Ethiopia managed by the government where farmers actually work on asset creation and get like transfers of food or cash. And then the farmer was saying, I'm interested by insurance to cover my production against drought, but I cannot afford it. So can I work a few additional days and you pay the premium? And that's how it all started. So that's the first integration. And then we introduced additional components like the risk reserve, which is basically the village saving and loans approach, and the prudent risk taking, which is broadly helping farmers to cautiously invest more and access better to market and to financial services. So this approach of how they can pay the insurance with their labor is called insurance for assets. Then on the other side, we have ARC Replica. So ARC is another sovereign risk pool that has been actually initiated by WFP some years ago and then transferred to the African Union, and that belongs to the African countries, which is slightly different from the other sovereign risk pools. So ARC is actually right now covering against drought only, but is developing on other risks, and is based on an index, a WRS index, where we have, where this index is trying to capture and to estimate the number of people affected by a specific drought, and then to measure the response cost implied by this specific drought. So it's not like over several years, but just on one specific drought, which is actually very difficult to measure. Once we reach a certain threshold, a certain amount of response, then there is a payment. ARC can pay up to 30 million, and this year actually Senegal is receiving $11 million for the drought. Once the country has subscribed, they have to have an operational plan that is approved by the ARC board so that they can actually implement the response. And that's a very big difference with the other sovereign risk pools where the government can actually implement the response as they want. So Replica, it's WFP and staff networks supported by the German government that are purchasing policies based on the same customization of the index and on the same risk transfer parameters. We try to align our operational plans with the ones from the governments, although there are always some differences, especially also in terms of costs. And this year, we are involved in 5 countries, mostly in West Africa, actually. Overall, we have 1.5 million beneficiaries of these two initiatives. We try to, we have 100,000 households being insured in R4, but we try to align so that we can have a broader figure that is actually comparable with comparable amounts. So a few challenges, well, there are many as you can imagine, but first one is the buy-in, the understanding, and ownership by local stakeholders. In general, what I've seen is that private stakeholders do not take ownership if they don't see a proper business case in this. And even with rather large portfolios, like more than 30,000 households being insured, like in Ethiopia, where we do represent around 4% of the gross premium collected by the insurance company, they still consider it as a pilot, which is kind of awkward, I would say. And that's the first problem. Similarly, the governments, both for micro and macro actually, need to see the cost, efficiency, and the impact of these initiatives. Otherwise, they won't take ownership and they won't support it. That's the reason why you're having some countries, well, I would say like India here, but in Africa, like Senegal, Morocco, or Kenya, that are strongly supporting these approaches. ARC has set up technical working groups to customize the indices, the risk transfer parameters, and to design the operational plans. But in most countries, the actual ownership is very low. First, most of the people from these working groups cannot actually use the software that ARC has developed. Still work very much in silos so that they don't really understand why we're collecting this type of data for doing an index, because like an index is actually quite different from the actual reality, and modeling the risk is quite difficult, and modeling it for insurance is even more difficult. So we're starting to work on this training on that. And on R4 specifically, we are trying to sign MOUs with our insurance partners so that we set up very clear processes of transferring the skills and transferring the responsibilities so that WFP is no longer in charge of doing almost everything with our external partners such as IRI. But that within the next 3 or 4 years, insurance company will be able to do the entire process from the product design to the distribution, contract management, reinsurance and pricing, and awareness raising and consumer protection. The political context, that's mostly for sovereign insurance. ultimately it's the Minister of Finance that subscribes the policy, right? So if the minister is not well informed and is not convinced by that, then you won't have anything. In Kenya some years ago, ARC would have paid $21 million to the government. But because there was an election, then the Minister of Finance decided that the 4.5 million of premium would be better invested in the campaign, probably, or in more direct activities that they could actually control. We've seen, and even this year, WFP has subscribed the policy in Mauritania, for instance, but the Mauritanian government did not. Also for financial reasons, but it's also because of political support. So the political context and the political support is critical in that. Expansion, scale-up depends on donors and government's money. So yes, you have like the fully commercial approach that you were mentioning, Thomas, but because we do work with very vulnerable people who cannot afford the premium, we need some support. And we need to build a graduation strategy where progressively farmers will contribute in cash and be progressively transitioned. Within 5, 6, 7 years, if I was giving you the example of Ethiopia, we're still at 25% only of cash contribution, which is very, very low. But also the food insecurity is quite high. So we try to find like what is the right balance and what is the right path. I'm of the opinion that we should go faster, but at the same time, I'm not the only one deciding, right? I mean, we need to work with local partners and the farmers as well. So that's very important. But also if we want to progressively transition that to social protection system, the government has to put some money on the table. And similarly, on the sovereign insurance, the government needs to mobilize funds from its own budget, which is very often difficult in many countries, and so they need donor support. So you're having some systems, I think like the GRIF right now that is supporting some governments, or the African Development Bank, but it's still like every year basically it's a struggle. Large-scale operation needs to be very precisely run, and I'm very much looking forward to hear from you after, because I mean, in terms of figures, much broader, but still like insuring 5,000 people and insuring 100,000 or 1 million is very different. You need to have like some very, very strong and very well designed processes to have everyone that knows what they have to do. Otherwise, as soon as one thing is disrupted, then the whole system doesn't work. And you cannot insure people properly. And I mean, of course, you can imagine we're working on some very strict timelines because climate risk insurance is based on very often the rainy season. So if we don't distribute before the rainy season, then that's a problem. And I must say, in some cases, I've seen the insurance company receiving the premium at the end of the season, both on micro and macro. That's not the right practices. Efficient integration is very challenging. I forgot that one, but that's a key one for us. So as I was explaining, farmers are paying their premium based on their work, so they need to complete the asset creation before we can actually distribute the insurance product. And they need to complete it before the start of the season. But before that, we need to have designed the product, priced the product, raised awareness on it. So very often we have like a very, very limited time to do that. And if one thing goes wrong, then the whole system goes wrong. So that's tricky. But then we also have like some other issues like on the VSL groups. So farmers are participating to saving groups that at the end of the year are sharing out what they've saved. Very often we have some issues in aligning the share out process when farmers are actually needing the savings to purchase the inputs and to produce. So that means that they don't have the money. So either they will buy the inputs 1 month later, which then makes them plant outside of the optimum planting window, or they will need some credit, which for their level of vulnerability, usually they don't have access to. Where am I? Yes, macro risk reduction measures. Well, yeah, no, I just wanted to make a little joke, but it's about the UN system. Of course, you can imagine that the UN is not exactly the most rapid system. I guess you can confirm that. So we also have some programmatic and administrative steps to follow, and that is not helping sometimes. Did I forget something? Yes, sorry. One key one about the regulations. So we have the CIMA code in West and Central Africa, in the Francophone countries, that is amazing because it has a book specifically for microinsurance and it has a decree specifically for index insurance. And that's, I think, one of the rare cases in the world where you have like first a regional regulation that went so far on that, and that's great. But that's not enough. So you're having huge differences between countries within this region. So for instance, you're having a lot of countries that actually don't have so much climate risk insurance and index insurance, and you're having Senegal that has a proper agricultural insurance company that has been set up by the government with the insurance companies and the farmers. You have 50% subsidies on the premium, you have like no taxes on the product, and with that, the whole sector has now really boomed and has reached like some very, very interesting figures. I think, I wouldn't say something wrong, but I think it's above 200,000 farmers that are being insured in Senegal, which is quite big compared to the other countries. And they're definitely running it as a commercial company with the support of donors and technical providers. But it's a business. At least it's becoming a business. No payout means participant satisfaction is low. And we need to build deep understanding of when insurance is efficient and crucial. Efficient insurance has to be for the infrequent but most impactful shocks, right? The problem is that you also need to show that the index is working, and you also have to show that the insurance is trustworthy and that they will pay as fast as possible. So we're having this situation in Kenya where in 2017 we made a payment to 5,000 farmers of $120. Everyone was very happy, of course. But last year we had like a bad year, but not a catastrophic year, which means that it was not a payout year, or like 2% in some locations. Of course, satisfaction was very low. And that's the reason why we're having an integrated and a comprehensive climate risk management strategy, which means that farmers should rely not only on the insurance, but also on the savings, but also on disaster risk reduction measures. But you still need to explain that, not only to the farmers, but you also need to explain that to the government, to the dairy channels, to the insurance companies, and well, basically to everyone. And that takes some time because if you do only one training a year, then there are 11 months that pass, and then people have forgotten almost everything on index insurance. So you need to restart everything. And that's the reason why we're trying to have like more frequent trainings. A few useful lessons learned. So insurance can be a shock responsive social protection tool. First, because we are targeting more vulnerable households that can be a priority for the governments, that insurance improves protection and optimizes resources, if not properly used. Insurance cannot be a standalone, again, and insurance should be for the very infrequent shocks. When it comes to the too frequent ones, then contingency funds, then savings are probably better. And if we have a product that costs 25%, honestly, I would say let's save, or let's use contingency funds. That's much more efficient. Then it also opens a large unreached market by private stakeholders. In general, the farmers that we're working with are not interesting for insurance companies because, well, they cannot pay. So, but at the same time, it's a huge part of the country, huge part of the population. So if we manage to create that graduation path and to make them transition progressively to the market, then it's a huge untapped market. In Ethiopia, we're having 35,000 people insured plus 10,000 pastoralists. So far, when we started, there was nothing in the market, and the market is still at very early stages, I would say. But if you take Kenya, you're having like more than 1 million people insured between the Kenya Livestock Insurance program, between the Acre Africa products, and what Pula is also doing
quite large scale. So that's actually very interesting, and the government as well. Also, microinsurance bring more direct added value to beneficiaries, like the transformative and promotion aspect that I was mentioning before, than a response only. And I think that's something very important because you're having the sovereign risks that are actually contributing to financing the response. But for microinsurance, we're trying to build something more broader and a little bit deeper. We're trying to build resilience in the long run. So we need to work with the farmers for more years. And so in Senegal, for instance, and in Ethiopia, we've seen that the productivity of farmers has increased a lot because they had either a better access to credit, and honestly, not so much, but just like a sense of being protected and a sense of being able to invest a little bit more and take a little bit more risk in buying inputs, basically. Hopefully in also applying better farming practices. But we've seen that in rice, for instance, in Senegal, in the south of Senegal, it was like quite significant. Then sovereign insurance contributes to funding governments and partners' response after major shocks. Yeah. This time I was told I could take as much time as I wanted, so I'm trying to be as long. But okay, I'm just 2 points. Well, the thing is, in the Sahel in 2017, there was a pretty big drought, and it took a year to actually seeing the drought, monitoring the drought, measuring the drought, the vulnerability, getting some fund, and starting the response. With sovereign insurance, you can actually start much, much earlier, and you can have like a higher impact on people's livelihoods. And again, I'm talking about drought and not fast onset here. Then in terms of training, is a long-term investment. With IRI, we started to train an index design team in Senegal, but also in Malawi, in Ethiopia, in Zambia. In Senegal, we started more than 3 years ago, and I'm really happy to see that they are very proud of being in this team, that they really own the process in most of the steps, but at the very beginning, they were kind of, yeah, but we just want to work on the index design itself and not the data collection, not the data monitoring, the seasonal monitoring. That's kind of boring. But now they're actually very happy doing that. So, but it's been 3 years and a half, and we still haven't finalized that. And then we have proven efficiency in building resilience. So we've shown in our different M&E systems that we managed to stabilize income, to increase capacity to repay loans, to increase capacity to invest, and to increase the production. And overall, we managed to improve food security, which is, I think, quite significant. Thank you very much.
So, good morning, everyone. I'm Melinda Grace Labao. I'm the officer in charge of Card Pioneer, and I'm here to share with you our insurance experience, particularly those related to natural disasters and climate change. But before that, just a brief background. When we started microinsurance in 2008, that was 11 years ago, we only had 28,000 enrollments. And we generated around $1 million in premiums. And this year, we are hoping to end at 19 to 20 million enrollments, or that's around 9 to 10 million unique individuals with $38.8 million in premiums. According to World Risk Index, or WRI, Philippines is number 3 globally in terms of having the greatest risk to disasters. We also rank number 3 on the list of most exposed countries globally, behind Vanuatu and Tonga. Exposure refers to entities such as population, built-up area, infrastructure component, environmental areas being exposed to the effects of one of more natural hazards like earthquakes, typhoons, droughts, floods, and sea level rise. On average, we have 15 to 20 typhoons in a year. In fact, these past 2 weeks, not just typhoons, there are areas in our country that were badly hit by strong earthquakes, averaging from 5 to 6.6 magnitude. This shouldn't be surprising given that our country is located near the Pacific Ring of Fire. Aside from that, the data shows that Philippines also ranks third among countries with the highest risk globally. Risk is understood as the interaction between hazard, meaning earthquake, flood, typhoon, and drought, rising sea level, and the vulnerability of societies. Vulnerability has three components: susceptibility, coping, and adaptability. As one of the pioneers of microinsurance and inclusive insurance in the Philippines, CPMI, or Card Pioneer, has been offering products to help the low-income sector recover when a natural disaster occurs. Again, the objective is not to replace the value of their properties or livelihood, but to help them start again by providing valuable and affordable insurance products. These are just two of the products we have in the market, both being offered to Card members. By the way, Card is the biggest microfinance institution in the Philippines. They have around 6.5 million members as of today. So the first product is Sagip Plan. Sagip is a Filipino term for rescue. So it is a bundled product, bundled life and non-life product. It provides personal accident cover of $3,000 US, $300 US burial benefit, fire cash assistance of $600 US, and for the residential property of the client, we insure it for $100 US against typhoon and flood, and $20 US for earthquake. Premium ranges from $34 US to $40 US. And when we launched this, by the way, this product is voluntary. It's not a mandatory program for Card members. But since we launched this product in 2015, we have issued 1.2 million policies and have covered 3 million individuals. For Binhi, Binhi is the English term for seeds or seedlings. On the other hand is our crop insurance product. This is barely new. We just launched this in 2016 on a pilot basis with Card members. Right now, we are only covering corn and rice against low pressure, typhoon, flood, and monsoon. This is not a weather index based product. This is an indemnity product attached to the agri loan of the farmer. And the average premium is 8 to 10% of the loan amount. So far, we have covered 14,000 farmers since we launched this in 2016. This slide shows you our loss experience from major calamities over the last 6 years. Total claims settled is $9.1 million US, which was able to help 135,000 families. The highest amount we settled was in 2013 and 2014. 2014 was the year Typhoon Haiyan badly hit our country. It was so devastating to the point that it wiped out thousands of residential and commercial properties and killed thousands of people in the central region of our country. From the $3 million US settled in 2013, 2.8 million was for Typhoon Haiyan, and we paid around 20,000 claims cases during that year. The following year was also a bad year for us because another strong typhoon hit our country, and we paid almost the same amount as we paid for Typhoon Haiyan. But if you notice, for the next 4 years, the claims settled dropped down, but still significant. So year on year, we expect 1 to 2 major typhoons in our country. So you may be wondering, where did the clients spend their money on? Was it for food, medicines, or clothes? No. In fact, the moment they receive the claims proceeds, they go to the construction company or construction store. They bought housing materials like cements, nails, sheets for the roofing. So the priority really at the time was to start rebuild their shelter. Of course, our journey in providing climate risk insurance is not always a bed of roses. There are also lots of challenges. Number one is lack of historical and is still insufficient current weather data, which is very important in risk modeling. Number two is pricing, because in the Philippines, there's a huge discrepancy between taxes of a life product versus non-life product. Tax imposed to a life product is only 2.2%, while for non-life, it's between 25 to 27%. So imagine offering a 40 US dollars product, 10% 10 US dollars goes to tax already. But this is something that the insurance industry in our country has been lobbying with the government to really cut the non-life tax so that we will be able to provide a more affordable climate risk insurance product. Number three is funding mechanism are not established. There's still limited funding from the government to help address disaster risk. There's no subsidies except for the program of Philippine crop insurance, their crop insurance, which is being subsidized. A portion of the premium is being subsidized by the government. There's also limited access to new technologies and technological support. Expansion and scalability is also an issue, especially in our experience for crop insurance product. Our crop insurance product, it is a mandatory program, but because of the limited crops that we cover and limited perils that we cover, we really have low penetration ratio in some areas. We don't cover drought yet, but hopefully by next year we'll be able to offer that peril. Cost of operation also for crop insurance is very high because we have to do lots of trainings, and since our program is indemnity, during calamity claims, we need to send our people on the ground to validate the claims personally. And then lastly, government regulation. Our government, particularly the Insurance Commission, has been very supportive with our microinsurance initiatives. They allow us to test different programs that help mitigate risk. But as mentioned earlier, one of the factors that drives the high premiums is the high taxes imposed to non-life products. And my last slide, which are the key learnings over the last 11 years. For number one is climate risk insurance is a practical and political solution. Climate risk insurance can definitely help protect individuals, particularly the low-income sector, from permanent damage caused by the impact of extreme weather events. In the short term, it can reduce the effect of natural resources, and in the longer term, can contribute to preventive disaster risk reduction. But climate risk insurance does not only have economic advantages. It is also a political tool that allows countries like Philippines, which are affected by climate change, to become more independent, rather than waiting for months or even longer for international aid or dole-outs to arrive. They are able to manage disaster risk themselves. Number two, it's no one-size-fits-all solution. Climate risk is no standalone solution. It must always be closely linked with preventive management strategies, ensuring losses and damages caused by a natural disaster are kept to a minimum. And lastly, good climate risk insurance is transparent and inclusive. Successful climate risk insurance is based on the inclusive and accountable involvement of beneficiaries and other local stakeholders, A transparent insurance that involves communities in the design and implementation is one that generates trust. Transparency about how money is paid out, collaboration with organizations that have deep roots in the communities, alongside ensuring the participation and inclusion of all, including women, maximizes levels of meaningful involvement. That ends my presentation. Thank you.
So thanks, Melinda, and for actually showing that it's not just the production risks that need to be covered when we are talking of a comprehensive climate risk insurance policy. So you have a scheme that is looking at the production risks of the smallholder farmers, but you're also looking at householder risks under the SAGIP plan, where accidental death and other aspects that do happen, and assets of the people, and the Typhoon Haiyan that you mentioned had other aspects than just impacting the production. So those are important aspects that we should look at when we are talking of climate risk insurance and disaster risk insurance in that sense. And just to put a couple of things of Matthew's presentation in perspective, a lot of UN organizations are actually involved in this policy, and of course all the Rome-based organizations, the WFP, FAO, as well as the IFAD, are intrinsically involved in it. And the room has a lot of UN representatives, so we hope that together we will be able to kind of make a difference. You heard the reference in Astrid's presentation to UNDP and the numbers of 500 billion being mentioned. So I guess that's where the issue is, that we all need to kind of pull and sing from the same hymn sheet, which has its own modalities of working along. So before I open actually the issue to the House to ask the panelists questions and share some of things, let's benefit from some of the regulatory presence here and the aspects according to that. And since we have Michael here from Ghana, Michael, can we hear, I mean, we hear that regulatory and facilitative regulations are required, and on the other hand, we have large numbers being talked about. We also have issues of micro segment being talked, and then we are saying that housing gets impacted in disaster risk. So what are the aspects that from a regulatory standpoint have to be looked at to ensure that all this comes together and becomes a slightly more harmonious point? So just a couple of reflections from your side being welcome. Can we have a mic for Michael, please?
Thank you. From Ghana, the biggest issue there is pricing. I actually saw it as one of the challenges from Philippines as well. Even though the issue in Philippines seems to be concentrating on the tax aspects, in Ghana generally is the pricing. The agri-insurance products are quite expensive, and it's because of the catastrophic nature of the losses. And so generally they are quite high. And if you add that to the cost of borrowing, it is very disincentive for the farmers, become very expensive for them to buy. One major challenge is that unlike in the other countries that we have seen from Senegal, from Philippines, where the government seemed to be so much committed to the agricultural insurance program, in Ghana there's a program, but it is struggling, and we don't have any support from the government. I'm talking specifically about subsidizing the premiums, and that hasn't happened yet. And so it is a big challenge, and even though we've been at our program since 2012 or 13, we haven't upskilled. We actually went up onto some thousands of farmers, and we dropped significantly because of the pricing. And then there are some other issues to do with basis risks and other issues which have fought against the upscaling of the program. So currently we are still working at it. We are still looking at how to get the government buy in. There are a few things that we are doing. Since we haven't succeeded yet, I will not talk about them for now, but maybe at another forum we will look at those as well. I think that the one big issue is about bundling credit with insurance, or bundling insurance with other things like credit, like seed, like other input, which we are also looking at. But basically, Ghana, from the perspective, when we get the government support, government commitment, that will improve. But there are a lot of initiatives from the government to improve the agricultural sector. But so far, they haven't been convinced that adding insurance to it can absorb a lot of the risks that are there in the first place. The other thing in Ghana has been we are talking about the role of the insurance industry, is the involvement. Some time ago, some of our companies ventured into agricultural insurance. This must be when I was a little kid, maybe in kindergarten or something. And the records show that they bent their fingers very badly. Obviously, risk management was not very good. And so when we started this program in 2012 or 13, there was a lot of reluctance from the companies to go in there. So they set up a pool to do this. In fact, it is the pool that they are still using. And if you know how pools work, because it's a pool, really, if it is an insurance company doing this, I'm sure a lot of effort, a lot of skill, a lot of capacity building would have gone into it. And so as part of one of the things we are doing to get the government attention, we are looking at whether it is the appropriate structure to use, whether it's being effective, whether we are getting the most benefit out of that structure. So
Thanks, Michael. Thanks for these inputs. And let me just take up a couple of points and ask the panel some of these issues that you're bringing about. So we've all been talking about public-private partnerships and the role for government. And Matthew, your projects involve working with the governments and taking their buy-ins, etc. And we are hearing some challenges from government buy-ins, as Michael just pointed out. How do you kind of get all these aspects together? The government to bring in the efforts, not just from the regulatory side, but also to invest on the sector per se, call it infrastructure, call it other side, and the private sector to kind of remain excited about the projects and move forward with it, because you heard Melinda talking about being one large organization doing it. So any quick reflections on that, on reconciling the public-private sector play?
Well, I would say, I would say that there's a lot of good political context at the beginning. It means that the ministers and ministries have to be convinced by that. So, I mean, of course, there is some training. So we actually started to work with the World Bank on building capacity in like disaster risk financing. So not specifically agriculture, but more DRF. And that's the first key thing. When you have like a Minister of Agriculture that is convinced that having some disaster risk management tools, including insurance, that are benefiting to the development of production, productivity, and to the market, and improving livelihoods, that's a good first thing. So we try to work on that aspect, and we also try to work on the social protection aspect, and that's key. So how insurance is actually a shock-responsive social protection tool. I mean, so far, I must say, we're not there yet. So we are there at the sovereign level, because, well, an ARC payout is definitely contributing to the response and thus to the social protection system. But on R4, except maybe with the PSNP that is led by the government, the other countries are still not fully convinced by microinsurance itself. But sometimes you're having some good contact, like again, Senegal, Kenya, even Burkina is actually like trying to work on introducing insurance and supporting it. And we're actually doing a pilot specifically to have lessons learned and to transmit to the government. And then on the private sector, it's also the same thing. So as I was mentioning before, if we don't have a proper business case, I think it's difficult. So we're just trying to show that if we raise like this amount of premium and this number of farmers, then it's becoming commercially interesting. And so, for instance, we have agreed in Kenya that a certain level of premium, all our partners, the insurance company and Pula we are working with, would work on a purely commercial basis. And so what do we do? Because our force is still too small, it will take us probably 2 to 3 years to reach that level. We're actually merging progressively with an IFAD project that is called Kesepkral, that is not working specifically on agriculture insurance, but more like agricultural development through e-vouchers. And so we're actually going that direction. Who mentioned this? Oh, Astrid mentioned the Zambia FISP project. We're also providing technical assistance to the government and to the partners so that we're improving the products and merging our four with this scheme that is currently insuring around 1 million farmers.
Okay, so thanks for that, Michael. I think from the private sector side, I'm sure the insurance associations will have a role to play at that point in time, and I'll come to you, ma'am. But first, let's open the question to a couple of questions from the floor, and then we can try and see how best we can utilize the skills available in the room. We have researchers, we have development sector players, so I'm sure we can look at them. So any burning questions for the panel? Any comments, experience sharing? You're welcome. The floor is yours. Okay, so let's start with you, though we had a lot of other people also, but let's start with you and then we can kind of quickly have the association. Yes.
While you were making a presentation and explaining
so if you can say one line to introduce yourself so that we have.
I'm Mohammad Musaddiq al-Haq. I'm CEO of a reinsurance broking company here in Dhaka. Right. My question is that while you were explaining about the BNHI program and that when you were mentioning about the premium, you had mentioned that depending on the loan. So is your program only limited to the borrowers? How about the other farmers? I mean, do you really cover other farmers?
Yes, thank you for your question. Right now, it's only limited to loan borrowers, okay. But we are looking at as early as next year bundling the crop insurance or our BNHI product with, let's say, fertilizer suppliers, seeds suppliers. So we're also looking
into covering them as well, right?
Yes.
Thanks.
Okay. Quick question from the first row, ma'am, from the Insurance Association.
I have a question for Melinda. The model you shared with us, what type of distribution channel do you use for marketing these products to the farmers?
Okay.
Melinda, before you react, let me just take a couple of questions just in the interest of time so that we can then collectively have these questions. Yes, Hannah, you had a question here?
Thank you. Yes, I had a question actually for Matthew. One of the things you said was how climate risk insurance is best for sort of less frequent events and that savings is probably better for the more frequent events. I was just going to challenge you on that because, I mean, one of the big problems in trying to stimulate and generate demand, I think, with insurance is that it's infrequent. And I think a lot of research is showing that the more frequent events that you can cover, actually the better, because consumers become more familiar with the products and that actually helps to sort of generate demand. So I just really wanted to get your sort of thoughts and your reaction on that. Thank you.
Thanks, Anna. We have a question with the gentleman there, yes.
Yes, hello, I'm Carl Hirulal with the Toronto Centre. My question relates to the crop insurance in the Philippines, somewhat related to the first question. Insurance premiums are basically based on the risk which it is insuring, but in this case, it's based on the loan or the loan amount. And the question in my mind is, how does the payout where premium is based on the loan amount compare to the actual loss that the crop or the farmer is experiencing?
I have two questions. My first question is regarding the affordability, because affordability of the, for the low-income household, because based on the presentation from Matthew and also from Melinda, so premium is the key challenge. Who will pay the premium? Even in Bangladesh, when you talk about the microinsurance product or climate insurance product, the first question came out from the people, from the government, from the private sector, even from the civil society organization, who will pay the premium? Because the low-income household, they don't have the capacity, they don't have the ability to give the premium. The question is come out from the different group of the people. And also seasonality, Matthew mentioned the seasonality is also another problem to design the product. So, because when you design the agricultural product. So my question is, I think Matthew and WP particularly working in African countries, many other countries, how they address these issues regarding the premium and how they engage the government and private sectors and also donor to address these issues. Correct. This is my first question. And second,
I thought you asked.
Yeah.
Anyway, so actually you brought up the issues of affordability and seasonality.
Yes.
Let's react to that and then let me come back to you for the
I have one more question.
Let me come back to you. Let's first get a reaction to you. So thanks. So Melinda, if you could react to the questions on the insurance modeling and how does it impact the people there and what kind of coverage you can offer. And then Matthew can react to issues related to affordability and others. Thanks.
Okay. To your question, ma'am, regarding distribution channel, currently we have more than 100 partners nationwide. It varies from rural banks, microfinance institutions, NGOs, even pawn shops, schools. So they are the one who help us distribute our products. For the rural banks and microfinance institutions, normally we cover their loan members. And then for pawn shops, we cover their clients that go to their pawn shop. So there. And then for the question about payment scheme for our crop insurance product, we have a payment scheme for rice and corn. For example, if the damage is between 80 to 100%, we pay 100% of the loan amount. If the damage is between 20% to 79%, we only pay 50% of the loan amount. And then for 19% and below damage, we don't pay anything. So that's the payment scheme that we have designed for this product. Again, it's a barely new product. We just launched it in 2016. We recognize that there are still a lot of challenges that we have to address. For example, covering drought, pests, improving our claims settlement process. So there's a lot of work to do for our crop insurance. Yeah. And then for the question about how we make sure that our products are affordable, again, our company does not dive into price wars. We don't do price wars. We make sure that the products that we offer are sustainable. So we have set of premium rates or standard rates that we use, but these are not fixed rates. Sometimes we approach an account depending on the volume, depending on the spread, and also type of clients that we cover. So we are very flexible when it comes to pricing our microinsurance products. Yeah.
Okay. So before you come to Matthew, so your question on this, the idea I think behind is the Philippines program is to keep liquidity with the farmers. So therefore, it's linked more to the loan amount and giving them back a part of the loan rather than having the coverage which has already been endorsed on that count. So just a quick reflection on that. So Matthew, this issue on how to keep the commercial interest that Melinda mentioned and the sustainability aspects with the affordability aspects, a quick reaction to your colleague from WFP would be great.
Yeah, well, so Is it? Yeah.
Yeah.
So, I mean, we tried, it's really difficult to calculate, to set up a good amount of premium for farmers who are actually not able to actually afford it at all. So that's actually the first tricky point. So we try to do gross margin analysis, so to understand what is the investment capacity of the farmers and the potential revenue out of it depending on their level of productivity from low to medium to high, and then progressively to adjust the amount of cash contribution that we ask to the farmers over time. And so we start with 100% subsidies from WFP to 100% cash payment within. So now the models are between 5 to 7 years. But it's tricky. It's really difficult, and in most countries, like all the stakeholders are actually pushing back and saying like, yeah, but it's been a very tough year, so maybe we could do something else. But at some point, it's difficult. So how do we do that? We work with the saving groups, which is essential, and that's the reason why like linking the two for me is really critical, because in general, even in very vulnerable communities, you notice that the saving capacity is much higher than you always expect. And so farmers actually progressively have enough amount to actually invest in the premium if they are actually convinced. But so far, I haven't seen like really farmers dropping the program because they were no longer convinced. In general, it's more like, saving capacity issue. On the frequent and versus infrequent question, I fully agree with you. On both macro and micro, well, you need to prove that the index works and that the insurance pays, and so that's why you need to have like high enough frequency to make sure that you will have a payment. The problem is that very quickly when you have that, you have small payments. So farmers are actually complaining, and governments are also complaining that it's not meaningful enough. That's when you can, I think, start making the shift. So you need a few years, but at the same time, you also need to have your insurance that is efficient. And so, for instance, on ARC, I was seeing a country last year that had a frequency of payment of every 2 years, which doesn't make any sense in terms of of insurance. And so we work with them just to convince to push that to 4, and I hope that we will, because like research in general says that it's around like 8 to 10 years that insurance becomes like really cost efficient, and beyond, before you need to have like contingency funds or savings or other systems. And on the seasonality, I'm not completely sure I had your point, no rule, but the thing is, it's really tricky when you have like one rainy season, so when you have 2, that's even more difficult. The big problem that we have is that every year we need to update the indices, and in some cases, like for instance Senegal or Malawi or Zambia, we actually have very stable indices now, so we don't have so much work as long as we don't have to expand, which means then again collecting some data and so on, but then we still have to price them every year. And every year it's becoming a challenge. And especially if you have like 2 consecutive years with payouts, you can be sure that you will struggle with the reinsurers, which is another issue.
Okay, so that's the multiple stakeholder approach that is there. I think we have time for a group of 2 more questions in case there are pressing. No, we covered them. Your second question? Yes. Or rather the 4th in the line, actually. Go ahead.
I'm so sorry.
No, go ahead.
Taking your time.
Just keep it short,
no,
please, so that we can
about again, I'm going back to Matthew. He mentioned when the people are protected through insurance, they invest more in production or productive work. But here in our country, our perception is totally opposite. So our perception is if people somehow protected through the insurance mechanism, they will not invest in the crop productions. They will be laggard. So they will be unwilling to invest in crop production. That's the perception I'm saying. So how we can change these perceptions through, from your study, you say the people are investing more in production, productive activities. So that's my question.
So it's a behavioral aspect, and I'll comment on that. Let them finish with it. But Toga, you had a question. Yeah.
So my question's for WFP as well. You're working on the micro level and the macro level, and your entry point seems to be government for both of those. How do you determine which population should be put in the R4 program and which category of a population should be part of the macro schemes. One of the things you've spoken quite a bit about is subsidies, and for some, maybe subsidy of a microinsurance program versus a safety net protection program, which is covered by government, is a decision they would need to make.
Okay. So, Matthew, a quick reaction to the second question first, and then we can look at the, yeah.
Can I ask you a question?
You may, but first you need to respond.
Okay, so on the change of perception, yeah, that's, so you never want that people, when they're insured, they stop working or they're starting to have like more, riskier behaviors. That's definitely not the point. I definitely think that receiving a payout is never as good as having a good harvest. And so that's what we need to explain to farmers. Even with every yield, which I think is even more challenging in terms of awareness raising, because, well, if I'm actually insured on my yield, then I have a low yield, I'm paid, well, let's not work. So you need to also like set up very strict processes and like to have like the right size of measurement of the yield so that one farmer or one community can actually not change that. But people need to understand that insurance will be efficient for them if they have like a really big shock that they cannot cover with their savings or their contingency fund in the case of sovereign insurance, and that they will always have interest in investing better, not necessarily more, but at least better, and producing better, and then like increasing their income generation instead of just relying on insurance, because insurance will only be there for the worst shocks and will only be a small piece. I mean, again, if we take ARC on the response cost in general, it's taking like very small percentage of the actual needs of the government. So the government has to mobilize some funds from their budget, from the donors, and ARC is only, well, giving a small percentage, like maybe 10, 15, 20%, depends on the needs.
So very quickly, let me just add one line to it. You heard Dr. Hiralal talking about just covering a part. The whole risks may not be covered by insurance. You heard Astrid talking about insurance covering residual risks. So insurance doesn't pay for the entire loss that you may be having. So I think this is one aspect we need to keep talking about, and consumer education has a huge role to play. But Matthew, in the interest of time, if you can shift to the second aspect of the entry level, I think I'll appreciate that.
Well, so my feeling, the targeting is actually tricky, but for sovereign in general, it's indeed like the most affected and most vulnerable population that are usually in the registries of social protection and are already receiving direct transfers. But then you need to target in the region that have been the most affected, who are the additional households. In general, I tend to think that for ARC, we have the labor-constrained communities who actually need unconditional transfers of food or cash or whatever, but who cannot actually work on the asset creation because they're already too vulnerable. And then on R4, we are more on those who can work but are still vulnerable enough that they cannot be directly transitioned to the market. That's more or less how we target. There is obviously an overlap. We try to avoid it as much as possible, but there is.
I'm sure there are more questions and more discussions to be had, but we have the coffee break to carry on, and we have the entire day to ask them as we move forward.